Good morning, good afternoon, good evening. My name is Jordan Kotick, and it is my pleasure to be joined today by Matt Lampert, Director of Research at the Socionomics Institute. Matt, as always, thanks for joining me today.
It's great to be here, Jordan.
Now, you have something unique in terms of the relationship between stocks and sex. Could you kind of give us the overall thesis of that?
Sure. So you might think that the crunch of an economic recession would impel people to have fewer kids, but what the data show is something even more interesting. Back in 1999, my colleague Robert Prechter studied data from the Dow Jones Industrial Average and births. And what he found was that the two tended to trend together with some interesting variations. For example, there was a major low in stocks in 1932, but a major low in births in 1933. A major low in stocks in 1974, but a low in births in 1975. And he realized, well, hold on a second. Is there an activity that would precede a birth by about a year, plus or minus 3 months? And that's when he realized what he was looking at. And it's conceptions, the conceiving of children, that actually seem to track the stock market. So when people are feeling more positive, more confident, more optimistic, they can express that by bidding up stock prices. They can also express that friskiness in the bedroom. And they can do the opposite when they're feeling less confident, less optimistic. And he realized that if conceptions are a coincident or even sometimes leading indicator of the market, that also means that they're a leading indicator of the economy as well. So people conceive fewer children and then the economy contracts instead of the other way around.
So just 2 points come from that, Matt. You're saying so they don't peak together. There's a lag of about a year or so, and that explains conceptions, not actual birth rates, right? That's the relationship?
Yes, yes. And one other thing that Prechter found was that when you get into the late stages of a bull market, market observers have noticed that there's a waning of breadth. In other words, there's fewer stocks participating in the uptrend. As they say, you need all the soldiers to win the war. Well, when you start having fewer soldiers participating in that uptrend, it's a signal that that uptrend might be maturing. And so stock market breadth tends to roll over prior to the trend in prices. And Prechter noticed that it's the same thing in the conceptions, that conceptions actually start to transition lower before you get major peaks in the market. He was writing in 1999, and he saw just such a divergence. And he said, well, hold on, we saw the same thing in the 1920s before the Great Depression. We saw the same thing prior to the major top in 1966. And so he said, well, this is an indicator that the market's likely to have a major reversal. He was writing in 1999. The dot-com bust began the following year.
The common assumption is that the market goes down. It affects your mood because you worry about your job, you don't have as much money, you're therefore worried about the future, and therefore you probably will not be as aggressive about pursuing children if you have that kind of option. But you're saying it's not that. So it's not the market moving down, it's the market moving down first, not the economy.
Well, it's the conceptions moving down first, and then the market, and then later we see a change in trend in the economy. So the conceptions tend to track market breadth indicators fairly closely. But there's one time in history where the conceptions turned down even before breadth started to wane, and that was in the 1920s. That's the only other time we've seen it before today. We're seeing the same signature in the data now. So that's one indicator that if history is any guide, it might be the economy that's the one that will soon be having contractions. Now, it's not a forecast, just a historical observation.
So it's not conceptions per se, it's the social mood that leads to conceptions that really this is about.
That's our take, is that what we're seeing here is a manifestation of social psychology. So when people are feeling positive and optimistic, they can express that psychology in a lot of ways. They can do it by bidding up stocks. They can do it by expanding their families or having children. They can do it by being more productive in the economy. But when that mood changes, when they're feeling negative, more pessimistic, more defensive, they can express that in a lot of ways, including by bidding down stock prices, choosing to have fewer children, and becoming less productive economically. And because you can trade a stock or get frisky in bed before you can, say, expand or contract a business, those trend changes tend to show up first in the conceptions in the stock market data, and then later in the data on the economy, such as gross domestic product. And one thing to add, and that is that some researchers at the National Bureau of Economic Research recently came out with a working paper that confirmed that conceptions started to head lower before the 3 most recent recessions. So this is a finding that's starting to get a lot of attention, and it's something that we've tracked going all the way back to Robert Prechter's study in 1999.
Since 99, have you and or Bob or your colleagues or your team at the Institute been doing more work on this?
We have. In fact, Mark Galashevsky at Elliott Wave International came out with some very interesting studies where he looked at not just births, but he added abortions data. And he found that, of course, by adding abortions, you end up seeing that there's quite a few more conceptions that happened. But the same qualitative trend in the data held after adding that data. He also studied the relationship between stocks and conceptions in other countries. He looked at Germany, he looked at Japan, he looked at the UK, and he found that the relationship qualitatively held in those countries as well. So we see this not just in American data, we see it in international data as well, and that's one signal for us that we're likely really seeing something that's common to human nature here. It's not just an American story, it seems to be a global story.
Mood matters. Bottom line, social mood matters.
Absolutely.
Well, Matt, thank you very much. I appreciate this. Look forward to reading all the research your team does and continuing this conversation at another date.
Thank you so much, Jordan. It's been fun.